Hey everyone, Anthony Venuto here with InTouch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for tuning in for another episode. On this episode, we're going to talk about how to improve your credit and what drives that 3-digit number or your credit score. So stay tuned, you don't want to miss this. If you're watching this video on the Team Sessa YouTube real estate channel, once again, thank you for clicking and thank you for your comments. Don't forget to leave those comments below. And while you're down there, don't forget to hit the like, share, and subscribe button and that notification bell so you can get notified every time we post a new video. And if you want to book a free consultation with myself or Santo, you can do that in the description box as well. But now, back to the video. Your credit rating or credit report, that 3-digit number that's attached to those items, is a very important tool used by financial institutions and lenders to determine your credit worthiness and your ability to repay. But it's not only limited to financial institutions, it is also for insurance companies, employers, and even landlords. They all utilize these tools in order to make an assessment of you as an individual based on this 3-digit number or your credit report. So it is important to maintain a very solid credit report and a solid beacon score, or as we call them now, FICO scores, and we'll get into that in just a moment. So looking at the overall picture, it's important to understand that credit is a journey, and for many Canadians starting out on this credit journey, maintaining a credit score is important. And we'll talk a little bit more about some tips and advice at the end of this video, so stay tuned. So obviously this 3-digit number is important. And if we look at lenders and we look at credit reporting agencies and we look at consumer products that are available to you and us, the masses, you'll see companies like Borewell or Credit Karma. And although these actual reporting agencies give you a number, it is not the same number or the same requirements that banks and financial institutions use. Financial institutions use Equifax and TransUnion, as these providers give a FICO score, which is a Fair Isaac Corporation score. And it is vastly different than what we used to call a beacon score. And the importance behind this is because it weighs out different components within your credit history, how you've maintained it and what you've done. So it is important to understand that that 3-digit number through FICO can range anywhere from 3 to 850. So looking at how that score is derived, it's important to understand that 30% of that score is actually derived by the credit limit and the credit outstanding or the balances owing. So if you take a second and step back and say, let's say you have a $10,000 credit limit or a combination of credit components, and you've utilized 9,000 of the total of 10,000 available to you. That is a 90% utilization rate, and that can have impact on your credit rating. So understanding that 30% of that actual rating is based on your credit limit to debt ratio. So that is very, very important. Coming in at 35% is your actual credit repayment history. Have you missed payments in the past? Were you late? Did you miss a mortgage payment? Has something gone to collections, or has something basically been written off by a lender? 35% of that number, that 3-digit number, is based on your repayment history. So making sure that you're on top of it is very, very important. Coming in at an additional 10% is new credit applications. How many applications have you submitted for? How many credit cards or lines of credits have you applied? The more you apply, the lower your credit score can get. So trying to avoid those things are very, very important. And one interesting point that we point out to our clients is that by using a mortgage broker, if you're looking to apply for a mortgage, it is vital that they understand that we only pull one credit report that we can take to many different lenders, as opposed to a client working with different lenders who each have to pull their own report, as that can add to the number of applications. Next is the length of credit maintained. How long have you had your credit for? When did you start this journey? And that comes in at 15%. So for example, if you're a new to Canada person coming into the country, applying for credit, or let's say a young student who is just starting off on their credit journey, your credit will be thin and it will be very, very young, as opposed to what we call mature credits, which are ones that have been established for a long period of time. And the last is a credit mix. And this is important. It's only 10%, but it does show a lot to the lender. For example, if you only have 2 credit cards and a high beacon score, obviously that could be very easily seen as a big number. It's an inflated number. But let's say you had a slightly lower number, but you had lines of credits, credit cards, car loans, and mortgages, and that score was a slightly lower. There is more meat in the mix. So there's more credit mix which can help drive up the score. So it's very, very important to understand that out of that 3-digit number, everything is broken up into components. Now, as we talked about the components and now you're aware of how that 3-digit number is derived, how can we help you maintain that credit or improve that credit moving forward? And the first thing is obviously avoiding missing payments. Do your best to make sure that at least the minimum payment is covered each and every month if you're not paying off your credit cards in full. And the best advice that we can give to our clients is to make sure that you have a pre-authorized debit set up. So if you're carrying a balance on that card, always make sure that at least the minimum requirement is paid on the due date automatically, so that if you do miss that payment or something happens, that you can basically be resting assured that that payment will always be made. Now, another thing that you can do in order to help maintain your credit, and things that go overlooked sometimes, is actually monitoring and checking your credit report once or twice a year and making sure that everything that is on there is correct. Obviously, in a new age with identity theft and credit card theft, it is important to understand what is reporting and what things can be removed and what things should not be reporting if there was an error. So obviously getting those reports through Equifax or TransUnion can help you rectify them sooner, because it could take months to get some of these things removed. And we do see clients coming to us sometimes that have credit cards that were closed or paid off that still show a balance, or sometimes a lease that was paid off or a car that was returned but the lease was never removed. And obviously when you're going through that pre-approval process or the purchasing process, having those things can take time to rectify. So monitoring your credit is very, very important. And the third piece of advice we'd like to give to our clients is obviously keeping those revolving credit limits low. As we talked about, 30% of those actual score, the 3-digit score, is weighted on the utilization. Keeping utilization anywhere from 35 to 45%, 40% will help you improve your credit score, especially if you were at the higher end. So if you were, for the example, having a $10,000 credit limit and you've used $9,000 of that entire limit, your credit score will decrease very, very quickly. The fastest way to get your credit score to improve is to pay that down significantly, and bringing it anywhere from, as I said, 30 to 35%, up to 40% will bring that score up in the next reporting cycle. And it's important to note that it all depends on when that lender reports that payment, as those can take anywhere from a month to 2 months to 3 months to report. But obviously keeping your limits at pace where they are and what you're spending is very, very important. And one other thing that you can do if you find yourself in a situation where your credit utilization is very, very high, and obviously I will err on the side of caution if you're going to do this, and as I said, do not take this as direct financial advice, but in order to help improve that credit score, and it has worked for some of our clients in the past where they've had pre-approval or pre-approved limit increases on those cards, is that you go ahead and apply it, because if that limit increases but your balance stays lower, that will improve that margin, helping you increase your credit score. Now, obviously, if you're a person that's going to find themselves utilizing that extra limit, and that limit may put you in further jeopardy of increasing your debt load, then I do not advise that you do that. But obviously, you do want to take everything with a grain of salt and understand your spending patterns and understanding how credit is important for any client. A lot of the lenders nowadays are looking at that credit number, that report, that 3-digit number, and they are assessing and assigning potentially a variance on how much money you can borrow. And that credit rating will also determine what type of lender you will have access to. Are you going to be working with an A bank because your credit score is good, or is it going to be having to go to, let's say, an equity or a private deal because that credit is really, really poor? So understanding credit is very, very important. So we'll leave the video here. If you enjoy the content that we're producing here at Finance Fridays and InTouch Mortgage Solutions, please feel free to hit the like, share, and subscribe button and that notification bell so you can get notified every time we post a new video. But until next week, we'll leave it here. Wishing everyone a great Friday. Thank you for clicking and thank you for watching.